Hello and welcome to Commodity Champions. I'm Manisha Gupta. The gift-giving season is here, and with it comes a surge in demand that many retailers rely on. Last year, the jewellery business saw sales sparkle as pent-up demand helped jewellers have their best Diwali in 25 years. However, surge in price of rough diamonds along with rise in discretionary spending has given rise to worries of a softening demand during this festival season. A spike in polished exports and rough diamond imports has helped keep the sector hopeful, but will that be enough? Sachin Jain is Managing Director of De Beers India. He joins us to now discuss about that and much more. Sachin, hi, happy festivities to you. And if last year was anything to go about, this year is expected to be slightly better on that as well. We do understand that when it comes to natural diamonds as a sector, India accounts for 8% of global demand. What is the kind of growth that you're expecting this year to continue?
First and foremost, Manisha, wish you a very happy festive season as well. And as I was sharing that we sort of sparked off Diwali in our office, in our sector today. So very happy and looking forward to the next week, which is going to be very important. And as you mentioned, last year was by far the best year that the industry has seen ever. And we were very happy that it happened at the time when it was really required. It was almost a comeback of an industry. And right now, the way we see in 2020 move, we think that India is an outlier in the global world. Right now, the demand for India continues to be very, very strong. The numbers that I see on your screen in terms of the share of India, which is about 8% right now, the belief that we have is that it's going to push further up as we go into the coming years. Last year, we saw the market grew at about 22%. And in 2022, we think that there's belief that there will be healthy double-digit growth. Now, to what number, we'll see in the next few weeks and months. But we all are very buoyant about what's going to happen. The clear shift is that the acceptance of diamonds and natural diamonds is very high. And the middle-level customer is by far consuming the highest that we've seen over the last few years. And what's led is transparency. What's led is more confidence in the category. And these combined with what natural diamonds really do as a core promise, which is their almost an internal gift of love, and that's really getting consumed and accepted well in the business.
Sachin, when you look at the last couple of years, the diamond prices have clearly surged up after years of consolidating. Will that impact the demand this time around, or do you think because it's a luxury item, it doesn't really impact that segment of crowd? Also, what are you looking at in sense of millennial demand, the new aspirational buyers also coming into the space?
Sure. So I think on your first question, Manisha, if you look at the maximum surge that we saw happen between the 2020 to 2021, I mean, post that, it's almost been, it's been quite steady. And, we all in the industry believe unnecessary spikes aren't great for the business. And we see that perhaps will not be the reason why the market will going to go up or down. That's one. So it's going to be pure led by pure demand and supply. And that we think is a fair balance right now. Now, on your second point on the millennial consumption, we see simplicity coming in. We see the average size of diamond going slightly bigger, which has been a trend we've seen for a few years. But what's really coming in is that really there's a clear divide of something that's very opulent, very big sizes that are doing very well. And we see that the young millennials are looking to buy products they can wear, fall in love with, wear on a daily basis. And that's become the way of life. So we see more, in our world, call it the solitaire driven pieces, which are more important pieces of diamonds in the centers, stones, and otherwise. That simplicity, along with slightly bigger diamonds, is what we think is going to be largely getting consumed in the coming time.
Sachin, if I had to just look at the ticket size now, if you look at last 1 year, what was the cheapest diamond sold, the lowest caratage or pointer that is, and what was the most expensive one sold in India?
Well, I mean, there is perhaps no upper limit on diamonds, and that's quite unique about the business. But I would say that diamond jewelry as a whole offering starts at a fairly affordable price. I mean, you can have a decent diamond jewelry for as good as about 10,000 rupees, for example. And the fact is that we believe that every single diamond is a rare gift of Mother Nature. So it's not necessarily that only big size diamonds matter. Yes, they are more rare. Yes, we find it difficult to find them. But diamonds are diamonds, and we think that every diamond represents something. Now, averagely, what we saw, the maximum growth that we saw was in the range of 1 to 1.5 lakh rupees. That was a segment that we saw maximum growth on. And we saw a maximum growth in the big size pieces, which is about 5 lakh plus. So these two segments really did well.
Sachin, I have a final question. And while, of course, we talk about the mother nature and the natural diamonds, but the lab-grown diamonds seem to be making those inroads and at a very fast pace and in the interiors of the country as well. What is the business there? What is the kind of growth you're anticipating?
Well, I think, Manisha, the growth that we've seen over the last couple of years is unprecedented, and I'm talking about natural diamond business, and that's happened because of what natural diamonds do and they stand for. So they stand for longevity, they stand for an asset class, they stand for a true gift that Mother Nature has. Now, the point is that lab-grown diamonds have a place in the market. Certainly they do. I mean, we've seen it happen over the last few years, but clearly I foresee over the next couple of years, they will form a space which is going to be fun, frolic, not value-based, and not perhaps for important occasions of life. That's why we see this industry getting towards, because as more you produce in the factories, the less or the more cheaper it gets. It's as simple as that. It's a technological product, and whereas natural diamonds are a gift from Mother Nature that hold value and have a representation. So they're completely two different areas. I don't think that there'll be complete overlap, and I think over the next few years, you'll see this getting clearly bifurcated in the minds, and most importantly, the hearts of the consumers. Because they will know what they're investing in, what they're buying, and what clearly gets represented by important moments of life and things that hold value, whereas something else which will be maybe much more fun, frolic, easy, and perhaps there's a very different segment.
I get it. You clearly are branding it very separately on both of those diamonds. I get that. That's a strategy there. I have one final fun question for you. I've been talking to a lot of industry representatives, and while they tell us, yes, earlier it was for spouse buying, and then it came about a woman buying diamonds for herself. And the way the numbers are stacking up, there's a lot of men buying diamonds for themselves too.
And women buying diamonds for men.
For men, okay.
That's an interesting, but yes, I mean, I see that metrosexuality, that's acceptance of how you believe you can get represented, is getting more simpler. Earlier, certain geographies were only where men jewelry was popular. I think it's getting more wider. Some segments of young and millennial and even Gen Z consumers are accepting jewelry as men, and that's a very interesting segment that we all will be very keen to build up.
Oh, absolutely. And the numbers do look strong there, and we'll keep an eye on to that one as well. Sachin, once again, thank you so much for joining us. Happy festivities to you, and we do hope that the industry does great numbers this festival season as well.
Thank you so much, Manisha. Wish you the same, and have a great season.
Thank you.
Wish you all the best.
Welcome back. You're watching Commodity Champions, and we now shift focus to gold. The yellow metal has seen lackluster in the third quarter of the calendar year, with prices dropping to the lowest level since March 2021. However, a weakening rupee and concerns of a looming recession could make gold a safe haven buying yet again. So is it time for you to jump on the bandwagon as well? If yes, there are many ways to do so. Although physical buying is the most traditional, the rise of gold ETFs and mutual funds make buying the yellow metal as simple as click of a button. So should you be looking at digital gold this festive season? To talk on that, Vikram Dhawan, Head of Commodities at Nippon India Mutual Fund, now joins us on the show. Vikram, hi, happy festivities to you. And while we have seen the trend of buying gold as an investment and not just for physical buying and wearing really seems to be catching up, how would you look at the last one somewhat and stack it?
Well, thank you very much for inviting me on your show, Manisha, and wishing you the festivities in a bit of an advance. Gold is, as it is seen by the investors, either as a portfolio hedge or as a outright investment where they want to see absolute returns on standalone basis. Now, if you see the performance of gold as a portfolio diversifier in the past 2 years, whilst the gold returns in INR terms have been flat, but the equity returns have been reasonably good in the past 2 years. And in the past 1 year, it's just the reverse. While equities have given flat to negative returns, we have gold, which has given positive returns. So gold actually has delivered as far as the portfolio diversification or portfolio hedge is concerned. Now, with regards to investors which look towards gold for an outright investment, expecting a standalone absolute returns, I think there are a couple of things they need to appreciate. First of all, every 2 to 4 years, the leadership amongst various asset classes in terms of annual returns changes hands. For
Sure.
instance, in the past 5 years, gold has outperformed equity twice.
Okay.
Obviously, now the question is, which asset class will outperform in the next 1 year?
Okay.
I mean, if you have the wherewithal or a model to forecast it, then excellent. Otherwise, the next best thing to do is to figure out which assets and which asset classes are relatively expensive or inexpensive. And especially the inexpensive one, you can focus your attention more on that.
Clear.
And in my personal opinion, I would categorize gold and most of the other precious metals as inexpensive on a relative basis.
Okay.
There are other couple of very important factors which the investors need to keep in mind. First of all, the way that the macroeconomics is unfolding globally, it appears that we may be in a situation where the trajectory of each country and each region in terms of inflation, in terms of GDP growth, in terms of interest rates may vary.
Correct.
Now, if that were to play out in the next 2 to 3 quarters, there is a distinct possibility it may lead to even higher volatility in the currency markets, which we have seen in the past works in favor of gold. Whilst, as we have seen in past 1 year, gold prices haven't gone anywhere in dollar terms. But when you talk about gold prices in yen, euro, INR, and in extreme cases, Turkish lira, they have given sizable return.
Right.
Last but not the least, inflation has also impacted the commodity players and even the gold miners. The all-inclusive sustainable cost of gold has gone up by almost 50% in the past 10 years. And to my mind, as per the data available, and what we have to also appreciate that the cost data from the mining industry comes with a lag, because many large players tend to have long-term contracts for the inputs to tide over the near-term volatility.
Right. That.
So, taking that into account, my sense is that today at least 5 to 10% of the global mining capacity, their margins are getting squeezed. So, I would say that the all-inclusive, all-sustainable cost for a greenfield project in the Western Hemisphere is not too far away from the current price levels.
Fair
so
point.
These are some of the trends which sort of, make gold a relatively inexpensive asset.
Point
Can the
taken.
prices go lower? Well, we have seen in the past, the markets tend to always overshoot on the upside and downside.
It does. Vikram, I also want to know if you're making a portfolio, one, how much of gold would you want to leave there? And two, apart from gold as a commodity within a portfolio, do you think other commodities have a chance of making inroads into a portfolio too?
So I think it first of all, it depends upon, your geographical reality. I mean, instance, in India, we are abundant in some commodities, but we have, strategic commodities like energy and gold and silver and, most of the EV metals, we are actually quite short of them. So, at some point, I think, it may make sense to have products through the mutual funds which sort of address this gap. Because that's where the liquidity lies. The liquidity today is either with the banks or with the mutual funds. And that is where, these opportunities can be tapped. But I think gold, you have to understand why gold is more relevant than the other commodities. I mean, I'll give you just one set of statistics. Before 2007, the size of the balance sheets of central banks versus the GDP used to be between 5 to 20%. This is pre-2007.
Okay.
And now, after two crises, that ratio has gone to anywhere between 30 to 60% and 100% in certain cases. So you can imagine the kind of, the fiat money assets backed by fiat money, the virtual assets or whatever you want to call them, have actually grown significantly. And the world, including the central banks, would need certain, real assets like gold, which are liquid outside the market trading hours. I mean, you can take a gold bar anywhere in the world and you won't get, too much of a, erosion in the price, the selling, the price of that. That, and also gold doesn't have credit risk. So I think as these numbers inflate as the debt GDP ratio of the world and the corporates and of the common man inflates, I think there will be need for certain real assets which are, we don't have credit risk, which have, most importantly, an ecosystem which is managed by large institutions, which ensures the fidelity and flow of the commodity.
Commodities. Well, absolutely. And gold does stand tall in that. And thank you so much, Vikram, for joining us and putting all of that in perspective on how gold is done vis-a-vis other asset classes in past and what can be expected in the year to come. A very happy Samvat 2079 to you as well. Moving on, and we are now joined by Chirag Mehta. He's Senior Fund Manager at Alternative Investments at Quantum AMC. And Chirag, hi, happy festivities to you too. And what the last few years have done for ETFs when it comes to gold and silver. But first of all, how has the growth been and how does the last Samvat stack up for you?
Thank you, Manisha, and wish you the best of festivities. So if you see gold, last year was a phenomenal year when it came to flows. We saw about 1750 crores of flows in the festive season months, right from September to December. This year also has been good. We have seen already 1450 crores of flows coming into ETFs. So we think that this festival season, I think investors are geared for buying more gold. Because we are seeing volatility in asset markets across the world, also in India. And gold has stood the test of its time, right? If you see this year, it's the only asset standing tall versus others which are languishing. So overall, that is a testament to the fact that it holds its value when it counts. So overall, we will see a lot of flows coming in terms of buying gold this year as well, given prices are even lower than last year.
Right.
So I think it makes up a good buying from all perspectives.
Okay.
And we will see a lot of buying.
Chirag,
And the appreciation of assets like gold ETFs has increased significantly over last few years. If you look at 2019 numbers, we just had 4 lakh odd investors in ETFs. Today, we have 45 lakh odd investors in ETFs. So that has grown significantly over last 2-3 years. And if you look at the asset base also in terms of flows and AUM has increased significantly. So overall, we were at about 5,000-6,000 crores in 2019. It has grown to close to 20,000 crores now. And if you look at the investor base, which has grown 10 times, that tells you it has led to more people adopting this form of buying, because asset growth is just 4-fold versus investor base increasing by 10-fold. That tells you more and more investors have come in and tested this instrument of gold ETFs and have been buying it.
Well, absolutely. Those numbers are very, very impressive, what you spoke about, Chirag. How would you, of course, we've seen new investors come in, but what really is the age group here? I mean, is it like still people who are moving their portfolios, or do you see millennials as well joining the bandwagon?
Yeah, millennials have come into the stock market in a very big way. We have seen a wave of new demat accounts being opened in India, and many of are participating in equity markets. Though most of them still are not attuned to buying gold the way the older generation has been. So I think, but they are learning it given the volatility this year that we have seen. Many would say that having an allocation to gold will make sense. So I think they are learning it the harder way, and I think they are investing in gold ETF. Plus, what's reassuring is the reach that gold ETFs have, because even terminals, stock market terminals in tier 2, tier 3 cities where these participants are also present, gold ETFs can be bought through the same terminals. So they have access to that door, and they can buy shares, they can buy ETFs using the same mechanism. So I think the adoption will be much quicker to the millennial generation. But so far, it's been the savvy investors who have learned and seen cycles over years and are adopting gold as a meaningful allocation within their portfolio.
Chirag, I have one more question for you, and this is on how long do you see people hold their holdings when it comes to ETFs? What is the ticket size that you see most people investing within? And what is the kind of growth that you've seen on an year-on-year basis, incremental growth over the years?
So what we have seen is up till the last bull run that we saw from 2008 to 2011, or markets peaked actually in India in 2012-13. Till that period, we had good amount of adoption and a lot of people buying gold. But when it went to a bear market and we saw some outflows, but most of the investors who kind of took it in the right way in terms of allocating to gold rather than just betting on gold, they have stood along with gold. They are holding in gold ETFs.
Okay.
So overall, much of the investor base is sticky. Much of the flows that we saw post the COVID crisis are still there along. Most of the investors are staying pat. So we are seeing investors stay in for a 5-7 year kind of horizon with their gold allocation, because treating as an allocation, because it's there for the rainy day and not really betting on the gold prices, betting on the returns that they receive, which are decent enough on a longer term basis in gold.
Fair
are
point.
kind of just adding to the flavor that they have, but it's more risk mitigation tool that they have in their portfolios.
All right. So clearly, it's as sticky as the space that it comes. And I really got stuck on that number, that from 4 lakh investors in gold ETFs in 2019 to nearly 40 lakh investors right now. I mean, that tells you the story on how people are buying gold in India. So gold ETFs clearly is the way to go. Chirag, as always, thank you so much for joining us. Happy festivities to you. And with that, it's a wrap on this edition of Commodity Champions. Thank you so much for watching.